Hi, everyone. My name is Ara Tapuzian. I am the Executive Director for Michigan Venture Capital Association, and we're here today for another webinar. We've been doing these periodically since really the onset of COVID-19, and we've been continuing to do these on sort of a frequent basis. I think this is our seventh or eighth one that I've done. And today we felt that it would be great to bring in a panel of out of state. So those of you that are out of Michigan watching this, Michigan Venture Capital Association, we're comprised of the Michigan investment and innovation ecosystem. And so we thought we would bring together a couple of folks that are VCs out of the state of Michigan to kind of give some perspective on some different subjects. So with that, we're gonna jump right in, and we're gonna do some introductions. We've got three great panelists, and so I'm going to start with Greg Robinson with 4490 Ventures. Greg brings a blend of VC investing and startup operational experience to each investment. Prior to 4490 Ventures, Greg was a managing director at Bay Area-based Peninsula Ventures, as well as a co-founder of Cogent Technologies, an enterprise software company that was acquired by Brightstar. Greg founded 4490 in 2014 and has almost 20 years of VC experience. Greg also has a master's in business administration from Tuck School of Business at Dartmouth and a Bachelor of Science in Economics from Arizona State University. Greg, welcome today.
Thank you.
We also have Tom Ball with Next Coast Ventures. He's a founding general partner. They are a VC firm that focuses on early stage IT companies with primary focus on internet software and technology enabled business and consumer services. Tom was previously at Austin Ventures from 2005 to 2015, where he served as a general partner. And he was also the first investor in a firm called Retail Me Not Incorporated. And Tom is also an MVCA member. So welcome, Tom. Thanks for being here today.
Thanks for having me.
And then we've got Greg Beaufait with Dundee Venture Capital. He's a partner over there. He's been with the firm since 2013, and he's been responsible for sourcing and managing deals, fundraising, and leading the Minneapolis office. Greg started out as an intern at Dundee before graduating from the Heider College of Business at Creighton University with degrees in finance and economics. Throughout Greg's tenure at Dundee, he's touched really every aspect of work that they do there. And he's led investments including ANRA, Costello, DataAnchor, Gather, Pair Commerce, and Ripple Science. Greg, welcome. Thanks for being part of this today as well.
Thanks, Sarah. Great to be here.
So we're going to jump in, and I gave everybody kind of a sort of a quick synopsis of each of you, but I'd like to know a bit about each of your VC firms and sectors that you really, we talked a little bit about that, but maybe jump in a little bit more as far as the types of deals that you're working on and that your firms start. I'm going to start with Tom. You want to lead us off and talk a little bit more about Next Coast?
Sure. So we're headquartered in Austin, Texas. Spend a lot of time in Austin. Spent more time in Austin here in the last few months than I have in a long time, though, given that I've been sheltered in place most of that time. As you mentioned, we focus primarily on software and internet. Don't really consider ourselves to be sectorial and tied to software and internet. Frankly, if you look at it, software and internet kind of touches every industry out there. So we try to apply a little bit more of a thematic approach to our craft. And we've got a bunch of themes on our website, which we spent some of this downtime revamping, which we'll launch on a new website here soon. But things such as the future of work, kind of the changing way that retail works, And we really look for the intersection of those versus, those with software and internet related things, because that's what we've done as entrepreneurs before we got into this business. We started the firm in 2015. I started with a longtime friend, Mike Smarklow. We met out in Silicon Valley when we both lived out there 20 plus years ago. We ended up raising Fund 2 in Q4 of last year, which was a $130 million fund. We spend, as I said, a lot of our time in Texas, but we call it Next Coast for a reason. We don't call it Texas Ventures or Austin Ventures, which would have been difficult. But we spend time throughout the Next Coast, as we call it. So Michigan's an important market for us. We both grew up in the Midwest. Mike grew up in Toledo, Ohio. I grew up in Kansas City. So, I think the people on this call are probably our people as we think about it.
Excellent. Great. Thanks, Tom. Greg Robinson, how about you?
Yeah, I think we share some similarities to what Tom was talking about, but we've been around since 2014, raised Fund 1 in 2014, Fund 2 in 2017, and with any luck, if we get out and about again, raise Fund 3 here in the next 6 months or so. But we focus on really everything other than both of the coasts, so we don't want to find ourselves spending too much time or money out on the West Coast or even the East Coast, and we feel like there's really a rich opportunity kind of in the middle part of the country, and that's kind of, I think, why we're all here. We focus on, really Series A companies, first institutional dollars into companies, and we invest in what we call connected software, which is, kind of our belief that, being just a great software company isn't quite enough anymore, that you need to be connected to some other proprietary asset like a data pool or a piece of hardware or something else that provides a kind of a secondary moat for that business. And so we're based in Madison, Wisconsin. We try to do everything, every good deal we can kind of close to home, but, in reality, we're really, other than the two coasts, we're open for business in terms of new opportunities.
Great. And our other Greg.
So, like you said, I'm a partner at Dundee. Dundee's a fund based out of Omaha, Nebraska. I'm in Minneapolis for us. We've got one partner in Chicago, and as of Monday, one partner in St. Louis, which sounds like a giant team, but there's 6 of us across those 4 offices. Now, we're generalist investors. Our lens is geographic, so similar to Tom and Greg, middle half of the U.S. We think of our geography as 25 states, kind of mountain range to mountain range, and then stage specific. So we're seed investors. To us, that means pre-seed, seed, post-seed, really anywhere up to a Series A. First institutional round of the company raises is typically what we want to be a part of. So we're cutting $500,000 to $1 million checks into $1 million to $3 million rounds. We're generalist investors otherwise, mostly software, some consumer as well. We stay away from hardware, anything requiring regulatory approvals or that has regulatory risk or government risk involved in it. We've been around a decade now, made 50 investments in 20 different cities across that region. Just kicked off our 3rd fund, which will end up in the $50 to $60 million range.
Excellent. Great. Well, thank you guys. So I would be remiss if we don't lead this off to really kind of address the elephant in the room, which is certainly COVID, right? But we're not going to focus on a lot of that today, but certainly wanted to see how this has really impacted each of your firms, but really more so working with your portfolio companies too. And I'd love to get some insight as far as how you've been working with your founders. How are they doing? This started several weeks ago, and my hope and thought would be that folks are operating more in the offensive stage at this point, and not just sort of reacting to sort of a crisis. So, Greg, let's stick with you, Beaufait. Talk to me about that as far as how this has all sort of impacted your business plan and some of your portfolio business plans.
Yeah, I would say, and I'll take a positive lens on it. Startups are on the right side of change. Typically, they're enablers and proponents of change. And I think what we've seen with COVID, it's been an accelerant of so many long-term trends that were going to happen, but we might have compressed 10 years of change into 2 years, or even 2 months in some cases in certain industries. So I think that's the long-term positive. Now, the odd thing about this event was you could be a travel startup and be on one side of the spectrum, or you could be a contactless payment startup and be on the other side of the spectrum, impacted by this positively or really negatively due to no fault of your own or nothing you did right or wrong. So I think that was the difficult part of what happened kind of starting mid-March. But either way, we see startups and entrepreneurs as resilient, and you take what's in front of you, you take what's happened in the ecosystem, and make the changes you need to as a business to survive or thrive in a given case. We've seen, even in the last month or so, buying behavior both on consumer and on B2B really come back. So when some of our companies were forecasting 20-30% of their original targets on bookings and budget, now it's come back closer to 100% industry dependent over the last month or so. So I think things have stabilized, but in terms of long-term macro opportunities, I think there's a lot that are coming about as a result of this.
Tom, what about you?
I think Greg did a great job of summarizing there. I think, what we've seen here in the last, call it 2 to 4 weeks, is to the way you described it, Ara, it's certainly shifting back more to offense than defense, it feels like. I think that right when this all started, and it was quite a shock to everybody's system, it was the scenario planning Zoom conferences where you had 5 or 6 of those a week per company oftentimes. But, we've gone from that, and now much more talking about how we're back on the rails, and what's the plan is to get back to the office and things like that. We have seen an uptick. I think, knock on wood, most of the plans that the companies did around when it first started were conservative, rightly so, and let's make sure we don't run out of cash. I think most of those have proven to have been very conservative, and we're seeing companies outperform those. As Greg said, buying is happening, companies are selling. I think, the thing that we haven't completely seen come back is fundraising, both from, and we're fortunate at Next Coast that we don't have a ton of companies out raising money right now. We had one that did get a round done without ever having met the venture capitalist, which was amazing to me. So all done via Zoom. So that was nice. But new deals and kind of inbound interest has been out there, but not a lot of movement through the pipeline. As far as we're doing it, it's we're still looking at deals, want to do deals, but it's going to be, I suspect this will be a question later in this, but it'll be an interesting process change for how we're going to do deals going forward, as long as we're not able to travel like we used to.
Yeah, definitely. And we will definitely address that. And I do want to talk about, the face of fundraising too. So, before you do that, Greg, anything you wanted to add to that? If not, I'd love to get your take on what you think the face of fundraising is going to be like moving forward.
Yeah, I'll kind of just jump off there. I know for us, we have two new investments that we're working on right now that, one's pretty close to closing, another one that's, maybe another month out. But one was a pre-existing relationship. We've known the company for a long time. And one was a company that we got introduced virtually. And the whole process, including trying to build a syndicate, has been done virtually. And so that was our first experience, to Tom's comment of doing this. Usually we spend a lot of time with the company, get comfortable with the people, largely speaking through that. And so, we're doing that. We're trying to find our way through that path to still feel like we're making good decisions, but doing it in the new reality. It has been interesting to try to run an entire process, including building a syndicate around with that dynamic. But I'm optimistic that you can do that and it can get done. And I think that the consistent thing that we hear from our co-investors and other people that we talk to, I think, is that investments are certainly going to get done whether they're virtual or not, but the bar has certainly been raised for kind of everything. And I don't know if valuations will change as much as some people thought that they probably were going to, maybe 2 months ago, 3 months ago. But I think it's probably just more a function of, will an investment get funded versus will it get funded at a lower price. And so I think we just have to be aware of kind of, I don't know if it's only half of the deals that would have gotten done or getting done now, or what the metric is, but it's some sub-segment of, kind of just the best, most promising, fastest growing, most efficient companies that are getting the financing at this point.
Right. It seems like it would be, the onus is going to be more on the entrepreneurs to almost step up their game, because funding is going to be a bit limited. Have each of you seen a great swing as far as valuations so far? Anybody want to tackle that first? Tom, what do you think?
We haven't. I think it's as Greg B described it earlier. It's depending upon which side of the coin you're on. A lot of companies really benefited from this. So we have had a couple of those raise, kind of almost inside rounds from bigger funds that we're invested with. And those valuations were quite healthy because they were on the right side of the coin. Fortunately, we haven't had any be on the wrong side of the coin that needed to raise money. So I suspect that would have been pretty harsh if that would have happened. But we've done, and our strategy is a little bit different. We have a little bit of our fund called the innovation part of it, where it's much earlier seed stage stuff. The Series A and B stuff, we haven't seen it swing as much as I probably would have thought it would have. And then on the innovation stuff, it's so early and small dollars. I don't think there was much wiggle room for those valuations to change much. So frankly, we haven't. I would have thought it would have been a lot more dramatic than it has.
Right. Okay. I see the other two, both Gregs are nodding, so I'm assuming the answers are somewhat similar. Let's move into a little bit about Michigan. Certainly, we've got a number of folks that are online that are from and in Michigan, and actually, I'm going to take one of the questions that we've got from the chat, because I think it's a good one. It's from Jeff Renvelt, who is with Renaissance Venture Capital. He's one of our board members too. So it's a good question. And Jeff says, if Michigan could add one thing from another region you invest in, what would it be? Who wants to? I'm gonna go by expressions on people's faces. The one that they have the best seem like they have a good answer. Tom, I'm going to stick with you. Because you're actively looking at Michigan quite a bit. So what do you think about that?
Yeah, well, we're fortunate enough to have Renaissance as an LP, so hopefully I don't screw this up for Jeff. I think it has all of the ingredients that you need. It has, great risk-taking culture, university, it's got successful exits. I always kind of hear this question, and I frankly never have a really good answer. I think the thing that and it's impossible to do this, by the way, but I think the thing that it doesn't have is just time, right? Like, I think these things take time, and I've always described it as, I'm very fortunate to live in Austin, right? And a lot of people come to us and say, how do we create the next Austin? And it's like, well, it's an overnight success, which it's not. It's been at it for 35 years. So I think time is the variable that unfortunately you can't import into another market, but it's going in the right direction in every single way, as far as the ingredients, as I says, as far as, you have big exits, which kind of creates this circular motion around risk taking and wanting to give back to the community. So, it's the way I always describe it, and I always screw it up when I describe it this way, is it's you can't turn up the oven to 900 degrees to bake a cake 3 times as fast, right? It takes time, and I think you got to give it time and be patient, but it's got every ingredient. So I don't have a great answer of what else it needs. We look at it, and that's why we love the market and want to spend as much time and looking at deals there.
Right. Let me continue though with that. And what types of things are you looking at here in Michigan? I mean, what are the types of companies? I mean, we know what sectors do well here in the state, and they very well may be similar to what you're looking at, but what are some of the special things you've looked at here?
Yeah, there's Greg B is on the board of one we've spent some time looking at, because we've weirdly kind of backed into this, having number of things kind of related to healthcare related businesses and software, how it touches those. So there's a number of those there, obviously, that are good. With Duo having an exit, obviously there's a bunch of companies that have in the kind of security space, which have spun up recently as a result of that. So I think there's great companies around that. And then on the consumer side, you have companies like StockX in the region, which have created this interesting kind of consumer DNA in that market, which are frankly all things that we love. So again, it's a great, if you did the Venn diagram, it's a great overlap of the past successes that have spurred new startups that are interesting to folks like us.
Okay. Greg Robinson, what do you think?
Well, as far as the environment, and I'll talk a little bit about what we've seen there. I mean, the environment, I think Tom hit it on the nail on the head in terms of, these things take a really long time. Austin's been at it for 35 years. If you look at Silicon Valley, they've been at it for, 70 or 80 years. And the result of those things are these big, long tent pole type companies that change people's expectations of what's possible. And luckily, you have companies like Duo that I think can act as those things. And if you look at Austin's had a number of, kind of long tent pole companies. Maybe the one that doesn't, resonate as much today as it did probably 20 years ago is, companies like Dell. But every ecosystem you look back, they've had a handful of these really great companies that not only create wealth, but create mentors, executives, safe landing spots, all the good things that some of those big companies can do for ecosystems. And when you have those, you just have an unfair advantage against, everywhere else. And so I think that that's something that, hopefully, Michigan and all of these other kind of budding tech ecosystems are hoping for. In terms of what we see, we've spent a lot of time in Michigan, and we haven't made an investment yet there yet. We got very close on a couple of things, but clearly in kind of logistics and transportation, we've seen a bunch of things. Healthcare, like Tom mentioned, that's kind of a couple of things that I think that are Michigan centric, but certainly are kind of Midwestern and kind of their overall kind of feeling. So we continue to spend a lot of time there. We love the fact that there's a great research university there that is going to undeniably produce a lot of really smart people that are going to be looking out, over the next 5 and 10 years and what's going to be kind of on the cutting edge at that point. So we really like those types of influences. And I would agree. I think, between, Ann Arbor and Detroit and kind of the broader state, there's a lot of really good raw ingredients that, just needs to kind of come together and kind of really catch, kind of get its momentum going. But I'm really optimistic about what I've seen and what I like to continue to see.
Great. We like hearing that. Greg B., anything you'd like to add to that?
Yeah, it sounds like from Greg and Tom, which I agree with, patience, right? Like we're in the early innings here, both Michigan and the Midwest, many of the cities of really being startup powerhouses, and we're getting there. And if you even look at what's happened in the last 3 or 4 years with Duo and some of the large raises in Michigan and throughout the middle half of the country, like we're getting there, but it's still early. So we're excited about what's happening. I think in terms of, if I'm sitting in entrepreneurs' shoes, one thing to Jeff's question, what I encourage entrepreneurs to do differently is just go out on the offense, go out and reach out to VCs in the region, yes, but also on the coast, because what we've seen different than 5-7 years ago is coastal funds are willing to come into cities like Ann Arbor, Detroit, Minneapolis, any of these cities where maybe they weren't willing to 5 or 7 years ago, and invest really early too. So Tom mentioned Ripple Science, which is our first investment in Michigan that we closed in December. $2.5 million seed round. I sit on the board there. We got Rise of the Rest in from DC on that one. Mercury Fund, which is Ann Arbor and Houston-based fund, and not a single one of the investors we talked to ever mentioned, a company in Michigan being something that they weren't excited about, whether that was a fund in New York or the Bay Area or in the region itself. So in terms of day-to-day entrepreneurs, what can you do? Think bigger and go out on the offense as it relates to raising capital and talking to VCs. It doesn't have to be local, even at the earliest stage. It can be from the coast, and it can be from funds in Austin or throughout the country.
Right. Greg, talk about the the Mighty Middle, which is sort of an initiative that Dundee has been sort of part of. I found this and found it pretty interesting. And your focus is on seed stage deals. Could you enlighten the rest of us on more about the Mighty Middle?
Yeah, so the Mighty Middle is a term we coined for 25 states in the middle half of the country that we cover, mountain range to mountain range. So it goes as far east as Pittsburgh, on the western side of the Appalachians. It goes as far west as the Rocky Mountains, north to south in the U.S. And that's the region we cover. And we nicely coined it the Mighty Middle to make it easy, because some states don't like being called the Midwest. You know, Minnesota wants to be called the North, whatever it is. So the Mighty Middle is what we coined to cover that region. We just did a report with Crunchbase a month or so ago covering what's happened in this region, the Mighty Middle, over the last 10 years as well. And one thing we focus on is what's happening at the earliest stages. And this goes back to our founding in 2010. We were founded by an entrepreneur, Mark Haysbrook, who raised money from awesome VCs, Sequoia, Insight, Madrona, across 2 companies. Both started in Omaha, but all at Series A or later. He couldn't get a dime of seed capital locally at all or regionally. And he thought there's got to be a better way to do this. Like, why is it so dang hard to raise my first $1 million, $2 million as an entrepreneur, an experienced entrepreneur in this region? So that's why we focus at seed, and we see it as the on-ramp to groups like Tom and Greg and coastal funds that are willing to come in and fund companies as well. But it's still really dang hard to raise a seed round. So that's why we focus on seed, and that's why we're excited about funds willing to come in earlier. Groups like Tom's having innovation programs where they're willing to fund at the seed stage as well, and more seed funds in this region being started too.
Okay, excellent. So I'm going to switch and go to questions. We're getting a lot of questions that are coming in. I think the panel can see these. I'm going to kind of move around on some of these. Some of these were already kind of touched on, but this question comes from Sebastian, who is mentioning that cities like Flint, Michigan, are trying to move to college towns. What tips do you have for the entrepreneurial ecosystem in these areas? You guys know where Flint, Michigan is? Tom, do you want to tackle that?
Sure. Just want to make sure I understand the question. So trying to move to college town, cities are trying to move to college towns. I'm not sure I totally understand that, but I think the college town ecosystems, which I live in one, Austin, right?
Yep.
It's funny, when I moved to Austin, 15 years ago, amazingly, had a lot of friends in the Bay Area who had gone to UT, and they were all mad I got to move to Austin. Like, how do you get to move there? Like, you don't have any tie to Austin. And so I think it's the challenge. As I said, it takes time, but it's local support, university support. There's local business people who benefit. I think the person who's benefited the most is one of my best friends here in Austin from the rise of the tech system here is commercial real estate, for example. Commercial real estate people seem to make a lot of money. So it's getting the other parts of the community, I think, to kind of contribute to the tech or venture community, if you will. So for many years, the most prolific angel and seed investors in Austin were commercial real estate people. Yeah. And so it's you've got to pull the other parts of the community in to make it work, because they provide lubrication and eliminate friction for these things. The hardest part I've seen for college towns is when there's no money there, the graduates all leave. I went to the University of Florida, and I think Gainesville has interesting stuff going on. It certainly doesn't have enough going on for the caliber of university that it is, and what could come out of there. I kind of compare, Florida to Texas to Michigan, for example. And I think, UT Austin and Michigan and Ann Arbor have figured it out. University of Florida hasn't. So it's the lubrication and kind of connection with the other parts of the local economy, I think.
Okay. Greg, do you want to kind of weigh in on some of this too?
Yeah, I mean, I live in a college town as well, next door to UW Madison. And I would say that, being in a college town is fantastic. I mean, the great news is you get like some of the best and brightest coming there for school, but we suffer from kind of the same challenges that a lot of college towns do. at least half of our graduates, they want to leave no matter where they go. They know they want to get out to see the world, and you can't really blame them. And so, hopefully you can attract those folks coming back to kind of have that boomerang effect. But that is something that I think all of these towns suffer from. But you have to have a strong sucking sound to kind of pull them back. I think the one other thing to think about as it relates to college towns, especially with great research institutions, is oftentimes these institutions, they can produce great thinking and great professors and great IP that doesn't always translate into a company. And if you look at Stanford, which is really the Palo Alto's the college town of Silicon Valley, if you look at what they've done, they were really one of the first and probably the best at being able to create kind of the mindset, the vision, and the ability to create, whether it's just a group of people in a network, or whether it's really actually IP coming out of the university, but to create kind of businesses coming out of that ecosystem. And I think that's something, again, goes to maturity. Stanford's been doing this for 50 years, and all the universities are trying to learn how to do this. They're trying, they're doing the things. They're probably all struggling, but if you're going to be in a college town, you have to also think about not only how great is what's going on campus, but how do you translate what's going on the campus into something that is really commercially viable and really kind of venture fundable.
Okay, so we're going to tackle another question here that we've got, and I think I know a little bit about where this is coming from. But this person, Kevin, wants to know how you all feel about the healthcare market these days, as far as it relates to innovation. I mean, I would think that this is something that's got everybody's ears perked up, especially with what's going on right now. Greg B., what do you think about that? What's your feeling on this?
Yeah, so I would say we don't prioritize healthcare across our firm just because that hasn't been a specialty or experience we necessarily had on our team, but we do invest in healthcare IT, and I think the opportunity there is healthcare is way too much of our GDP as a country, and still a really awful experience in a lot of ways. So there's so much opportunity to make that a lot better, 10x better in a lot of different ways, whether you're talking from the payment side of it, or you're talking from the actual delivery of care side of it, or you're talking just from the software side and the really niche specialty, oncology or radiation. You're looking at, how do we better identify, instead of a doctor doing it, how do we use technology to identify some of those diseases and the progression of those. I think there's opportunity across healthcare. It's such a big bucket, but it's broken in so many ways. So absolutely happy to invest in healthcare, excited about doing it. And I think healthcare is one of those industries the last 3 months that's, maybe seeing 5 to 10 years of change in a few months, and that'll continue to progress. So I think it's a great place to be in, investing in and building a company in as well.
Yeah. Tom, what about you?
Yeah, I think similar. We don't consider ourselves healthcare investors. I think there's a lot of specialist firms that do deep healthcare investing that are much smarter than certainly us around that stuff. As I said, we're much more thematic in how software and internet kind of touches other things. One of our themes is healthcare hacking, kind of self-health hacking. And we have an investment in a company called Everlywell, which does at-home test kits. Before COVID, they were doing it for things like cholesterol and STDs and things like that. They're the only just awesome team as going through this terrible crisis. I think they're the only company that's approved by the FDA for at-home COVID testing. It's certainly something that as you're in the industry, you learn more and more about, and that's deal flow for us. So the CEO of that, Julia Cheeks, sends us great deals that she gets through her network. As a result of that, we've done some things around health savings accounts and things like that. But again, it's all kind of tied to software internet. We're not investing in medical devices. So right. As Greg said, it's such a large part of the GDP, it's kind of hard to avoid it, right? It's for the way we all invest, whether you call it generalist or thematic or whatever, it's like it's touching every part of the country right now. So I think it's just going to get better.
Yeah. Let me move on to, we've got a few more questions. We've only got really a few more minutes left here, but we're getting a lot of good stuff. There's a question regarding small digital media companies. So Greg, who works in economic development out here in Oakland County in Michigan, is asking that question. Is this of interest to any of you folks within your firm, small digital media firms? No? The quietness says probably not so much at the moment. So that might be the quick and dirty answer.
I mean, I like digital media. I think it's a tough space. Again, on our teams, it's you have the large digital media companies, which makes investing in small digital media companies difficult, right? Like you Facebook and Twitter and things like that. So we do have a fundamental belief that that those big networks, if you will, have I don't think they've run their course by any means, but that there is going to be opportunity for, you know, up and comers, because it's just become untenable as far as how many companies in our portfolio use those big media companies to acquire customers and whatnot. It's gotten ridiculous, the economics around it. So I think media companies digital media companies are an interesting area. You know, small is hard, but they have to start small, I guess. But it's a crowded space, I'd say, but there's a lot of innovation going on, and somebody's going to figure some interesting things out. Like, you know, somebody's going to come up with what we're going to all look back on and be the next Facebook. So it's hard, but it's hard to kind of analyze those.
So to that point, we've got entrepreneurs that are certainly online and always looking for funding sources. You guys open to looking at increasing your pipeline? Do you have enough in the mix at the moment? I mean, what is it you might be looking at or would be open to? How about Greg R? I'm gonna go with you first.
Yeah, I think, you know, I think we'd be crazy to say that we have all the, you know, we've got enough. You know, we're always looking for the next, you know, great team and great idea, and so we're all open for that. I know for us, yeah, we're definitely actively putting money out, actively looking at new opportunities, and you know, would love to talk to anybody that you know, feels like they're a fit for what we're trying to do.
Okay. Yeah, I'm seeing everybody else sort of nod, and that's why I'm going to kind of keep rolling with this. There is a question regarding NSF funded projects. What kind of weight do you guys give to companies that are working with those? Who'd like to tackle that? Or are you not working in that arena? We could probably bypass that. Yeah. Okay.
My guess is that's probably a little deeper science than we do, at least.
Yeah. Okay.
Related to that.
Here's, we're going to take one more. With consumers changing their buying habits during the COVID, this is a good question. What is the investment interest in e-commerce platforms?
I can take that. We were founded by Mark, who I mentioned earlier. He started an e-commerce company called Hay Needle, and another one before that. So we look plenty in consumer, really in two angles. One is direct consumer brands, which is a super competitive space. Easier to build a $5 to $10 million revenue company than it is to build a $500 million revenue company in that space. But nonetheless, we like that space. We've invested in consumer brands. The other piece of e-com that we look at, we're excited about, we think is necessary to invest in further is e-commerce infrastructure. So how do you help everyone not named Amazon catch up and compete with Amazon in today's day and age? So we've invested a lot in that space, looked a lot in that space as well. So I think consumers a great place to be. My fiance works for a giant CPG company, and she's specifically focused on brick and mortar. And she tells me all the time, brick and mortar is 90% of sales, e-com is 10%, but that 10% is growing at a pretty significant clip, right? And will only accelerate in this environment, but also the next several years. So it's a great place to be investing in, and something we look at a lot and love to see.
Yeah, we the same. I mean, I mean, I started an e-commerce business that, we grew to a few $100 million of revenue in California. My first investment in the venture industry, professional investment in the venture industry, when I joined Austin Ventures, was a company called Bizarre Voice, which is the better to be lucky than good category. That was the first entrepreneur I met when I moved to Austin. And so, you know, e-commerce related infrastructure tools. I was the first investor in Retail Me Not. So it's a core part of our strategy. We've got, you know, direct consumer deals in our portfolio. We've got things that are kind of running on Amazon Rails right now. We've got things in fintech that are related to e-commerce. So it's a core part of our strategy. I think there's, as you said, Greg, it's, you know, it's if it's 10% of total retail, although, you know, things like Dick's Sporting Goods, I know it's gone from, you know, 10% to all of their retail for a couple of months there. So it's like, it's got so much headroom left. We love e-commerce related stuff.
Yeah. Guys, we've run out of time, but I want to definitely thank all of you. Greg R, as you're more affectionately known. Somebody should have changed your name today to make that easier for me, but that's quite all right. And Tom, I want to thank the three of you for being on today. And we didn't get to everybody's question. There were a few that I replied to privately, and you know, we'll try and get some of those maybe answered offline. But want to thank you again for taking the time to be with us today. I want to thank all the attendees that are online here as well. And again, if you're looking for some more information about Michigan Venture Capital Association, you can go on the web at michiganvca.org. We'll publish this video later with some different links and whatnot. But again, Tom, Greg, be safe, be well. Thanks again for participating today. And with that, I'll say goodbye to everyone.
Thanks everyone.
Everyone.
Thanks a lot. Appreciate it.